It's been another very good month for equities. In fact, a very good year for equities. We've had US equity indices are up 15 to 25% across the board. European 10 to 15%. Asia 15 to 30%. Sadly, just 5% in Australia. But generally, being invested in equities is remaining a very good strategy. And we've got a lot of people saying we should be very worried, including myself over the last few months. So, what should we be worried about, and what should we be watching for? We think that inflation is going to emerge, but let's just step back one more step from that and just talk about the rate hikes that are going on from the central banks. We're in this normalisation phase. We're in a very good part of the global economy pickup, an industrial reflation story that's not getting much debate, and it's why equities are doing so well. But the central banks are also looking at it and they want to normalise. So the Fed's done 3 rate hikes this year, 2, and they will deliver another one in December, we expect. Even the Bank of England's going to hike this week, with 90% probabilities priced. We've had 2 from the Bank of Canada. So the central banks are looking around saying, things are pretty good, time to start to normalise. So one question is, how far does that go? What does normal look like post the financial crisis? We're expecting about another 1.5% rise in interest rates in pretty much all the economies we look at. So that's the US and Canada and Europe and the UK and Australia and New Zealand. We think rates are going to go up about 1.5% over the next couple of years. Now, equities won't necessarily find that too bad. If it's just normalising and the economies are still strong, that's okay. So you can be still invested in equities and you'll do quite nicely. Where equities will get concerned is if it looks like the economies are overheating. And that's where we come in with our view about inflation and what's going to happen there. So we think the US in particular is looking like it's getting close to overheating. And so normalising interest rates actually won't be what ends up happening. We'll have to move to a restrictive stance, and that's when equities get upset and we talk about a recession. But in the near term, we've had benign inflation readings again for another month in the US and Australia. And so this concern about a pickup in inflation is a little bit more delayed. So our focus at the moment in our portfolio is that this normalisation will continue. The front-end rates, so rates less than 2 to 3 years, will continue to rise in all the economies that we're looking at. And that's the sort of first step in a global pickup that we're expecting to see. What we're remaining very alert to is inflation and wages picking up. If you're an equity investor, that's what you should be very alert to too, because that's when the bell's sort of ringing and saying it's time to be very cautious. But for the time being, it's really quite a benign Goldilocks environment. Look for continued normalisation, but no sort of panic move in rates for the coming couple of months at least.